In this video, we will explore about understanding market trends. We are going to look at the three main types of movements you will see on any stock chart, which are primary, secondary, and tertiary trends. As you can see on the simple graph on the screen, prices never move in a straight line. They zigzag up and down. To make money in the markets, you need to know which part of that zigzag you are currently in. Let us start with the big picture known as the primary trend. This is the dominant long-term movement of the market. Think of this like the tide of the ocean. It reflects the overall direction of the economy and investor feelings over a long period, typically lasting 1 year or more. We classify these into three types. First is a bull market, where prices go up because of optimism and economic growth. Second is a bear market, where prices fall due to fear or economic contraction. And third is a sideways or range-bound market, where prices are stuck in the middle, showing indecision. Now, you might wonder what actually causes these big trends. As shown on the diagram, there are several underlying drivers. It is a mix of economic cycles, like whether we are growing or in a recession, and monetary policy, which involves interest rates set by central banks. It also includes fiscal policy regarding taxes and spending, as well as geopolitical stability. Finally, investor psychology plays a huge role. When people are greedy, they buy. When they are fearful, they sell. All these factors combine to create the pressure that pushes the trend in one direction. So, how do we spot these trends before it is too late? We use specific technical indicators. First, we look at moving averages like the 50-day or 100-day average to smooth out the noise. Second, we draw trend lines connecting the highs and lows to visualize the path. We also look at the Dow theory, which tells us to check if volume increases with the trend. Tools like MACD help us see momentum shifts, and simply looking for higher highs and higher lows can tell us if the bulls are in charge. Why is this important for your strategy? Understanding the primary trend helps you with three things. First is portfolio allocation. You want to align your assets with the macro trend. Second is risk management. It stops you from betting against the tide. And third is timing. It helps you enter and exit at the right moments. For example, in a bull market, buying breakouts works well. But in a bear market, it is better to stay defensive or hedge your investments. However, markets do not go up forever without a break. This brings us to the secondary trend. A secondary trend is an intermediate movement that goes against the main primary trend. Think of these as the waves that crash against the tide. These trends typically last from a few weeks to several months. They are essentially counter movements. If the market is going up, a secondary trend is a temporary dip. These secondary trends play a crucial role in the market structure. They act as a healthy reset button. Their key functions are to digest the gains or losses from the previous move, shake out the nervous investors who have weak hands, and reset the market when it gets too expensive or too cheap. Without these pauses, a long-term trend cannot be sustainable. Let us define the types of secondary trends based on the market context. If you are in a bull market, the secondary trend is called a correction. This is a temporary decline, often dropping 10 to 20% before the uptrend resumes. These are also known as pullbacks. On the other hand, if you are in a bear market, the secondary trend is called a rally. This is a short-term bounce or recovery before the prices start falling again. Traders often call these relief rallies. Let us look at the typical characteristics of these moves. In terms of duration, they usually last from 3 weeks to 3 months. Regarding how far they move, They often retrace about 1/3 to 2/3 of the previous primary move. An interesting point is volume. The trading volume is typically lower during these corrections, showing that the big investors are not really selling out. However, volatility can be high because these moves are driven by emotion and news. What triggers these sudden shifts? Usually, it is a specific catalyst. It could be the release of macroeconomic data like inflation numbers or a shift in central bank policy. It might be a geopolitical event or a surprise in company earnings. Sometimes it is just technical exhaustion where buyers are simply tired. These events shift sentiment temporarily, but remember, they are usually not strong enough to reverse the entire primary trend. To identify these secondary trends, we use a different set of tools. Fibonacci retracement is very popular. It helps find support levels like 38.2% or 50%. Trend lines and channels help us see the boundaries of the correction. If the price crosses a 50-day moving average, it might signal a secondary move is starting. Also, keep an eye on volume analysis. If prices drop but volume is low, it suggests the dip is temporary. Strategically, secondary trends are opportunities. For tactical entries, you can buy the dips in an uptrend. For risk management, knowing this concept prevents you from panicking during a normal correction. It is also great for swing trading, allowing you to profit from these intermediate moves. For example, look at the Nifty 50 case study from the year 2020 to 2021. The primary trend was bullish after the COVID crash, but in late 2020, we saw a 7% correction. That was a secondary trend. The outcome, the market resumed its uptrend and hit new highs. Finally, let us zoom into the smallest wave, the tertiary trend. These are short-term price movements that happen within the broader trends. They typically last just a few days to a few weeks. To a long-term investor, this looks like noise. But for a day trader, this is where the action is. These trends are highly sensitive to daily news and rumors. As you can see on the pyramid diagram, the tertiary trend is at the very top, representing days or weeks. It sits on top of the secondary trend, which lasts months, which sits on top of the primary trend, which lasts years. Tertiary trends can move with the main trend or against it. Because they are influenced by daily sentiments and news flashes, they are the most volatile and hardest to predict. Let us break down their characteristics. The duration is very short, usually less than 3 weeks. They are highly volatile and react instantly to earnings reports or political gossip. You might see spikes in volume, but be careful because volume patterns here are less reliable than in the bigger trends. The direction can flip back and forth quickly. Because they reverse so frequently, you cannot use them to forecast the long-term future. To analyze these quick moves, you need fast tools. We use short-term moving averages like the 5-day, 10-day or 20-day exponential averages. Momentum indicators like the RSI are useful here. Traders also rely heavily on candlestick patterns like the engulfing pattern or the morning star to spot reversals. Volume helps confirm if a breakout is real or fake, and looking at support and resistance levels for the day or week is critical. So, why do we care about these small movements? They have strategic importance for precision. They help traders fine-tune their entry and exit points. For example, even if you like a stock for the long term, you can use a tertiary dip to buy it a little cheaper. It is also key for risk management, helping you place tight stop losses. Essentially, these trends reflect the immediate psychology of the market. However, there are limitations and risks you must know. The biggest problem is distinguishing noise from signal. In a choppy market, tertiary trends can be very misleading. There is a high risk of whipsaws, which is when the price moves in one direction and then immediately snaps back, causing losses. This can lead to overtrading, where you buy and sell too much based on minor fluctuations, racking up transaction costs. Remember, for a long-term investor, these small wiggles are best ignored unless they signal a massive shift.